Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into a post-pandemic world, risk management continues to be top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. This webinar will last 50 minutes and you must be logged on for the full 50 minutes to receive CFP credit. Be sure to ask questions as you have them by typing them into the questions box. Today's webinar is being recorded and should be posted on our website within 24 hours in case you missed it. Today's presenter joined LLIS in 2003, assumed the role of president in 2008, and CEO in January of 2013. He continues to monitor the insurance and financial services industry to provide you and your clients the most up-to-date recommendations. Here to wrap up our year is Mark Maurer.
Ho, everybody, and thank you, Claudia. I hope you've been a good girl all year. Ho. So hopefully that wasn't too loud in anybody's earbuds. But it's a time of year. We're wondering, are we going to be naughty or are we going to be nice? And what I want to do is help keep you and keep your clients off of the insurance naughty list, which I'm not sure if that list really exists. I'm pretty sure it doesn't. But if there was, hopefully we have 10 things that are going to keep your clients off of the insurance naughty list. So what's our very first thing? Keeping the owner information up to date. Now, for most of your clients and most policies, the owner is going to be the insured. So for 90%, maybe even higher, this isn't going to be a thing. So no worry about the naughty list for number one for 90% of people. I wish I had a 90% chance of not being on the naughty list. But for 90% of people, they own their own policy, especially if we're talking about term policies. You own your own term policy and you name your spouse, your kids, whoever is beneficiaries. Most of the time, that's what happens. With disability policies, you own it yourself. With long-term care policies, you own it yourself. Most annuities, you own it yourself or you own it jointly with a spouse or partner. So 90% of the time, this isn't a thing, but sometimes it can be. And it comes into play if we want to make changes. So what are some ways we can change? Well, we can change the ownership from between individuals. This might be changing the ownership to a spouse. It's probably the most common one there. A little more common, normally somebody doesn't change the ownership to a spouse. More common would be somebody changing the ownership from themselves into a trust. Clients get term policies initially when they're younger. As they accumulate assets, their planning gets a little more sophisticated. Maybe they they create revocable trusts. And so they move the policies from themselves into the revocable trust. It's not much of an ownership change because the revocable trust really is themselves, but it's a change. And so we're changing to a trust. There's also the ability for people to transfer life insurance policies to businesses and businesses to transfer life insurance policies to individuals. So much less frequently would be if someone has a life insurance policy and they want to make a business the owner. More than likely, this would be because they are buying into a business, buying into a practice, and they want to have the business pay the premiums and be the beneficiary, maybe because they have a note for a buy-in number of shares. More common is there was that key person life insurance, that buyout life insurance policy that a business owned. And the employee, the owner, is moving on. They're leaving. So the business can transfer the policy, whether it's a term policy, a universal life, whole life, VUL with cash values, to the employee, the owner who's leaving. So it works both ways. What's going to help keep you off the naughty list? Well, knowing that only the owner can make changes. Sort of makes sense. If you own the policy, you're the only one who can make changes. Where sometimes people forget this is when the owner is different than the insured. Most often happens with irrevocable life insurance trusts. An irrevocable life insurance trust is a completely separate entity from the insureds. Many times insureds forget who owns a policy, and so they want to make changes. The insureds call us, the insurance company, to make changes, and they're told only the trustee of the trust can make the changes because they're the owner. So now the clients need to talk to the trustee to see if there's changes to be made. But it's only the owner who can make changes. Like I said, usually this only comes into play when the insured is not the owner, people getting confused about who can make changes. A really, really good thing is to make sure that the owner has a bank account in place. In a perfect world, the premiums are paid from the same checking account, savings account, what have you, with the same titling as the owner. So if Mark Maurer is the insured and the Mark W. Maurer Revocable Trust is the owner, in a perfect world, there's a revocable trust bank account to pay these premiums. Because the revocable trust is similar to me and essentially me, that's much less of a thing. But when there's different, more formal trusts, that's much more helpful to have there be a trust bank account. And up-to-date trust or trustee information. Because what happens here is that someone sets up a trust 10 years ago. There was a trustee listed at that point in time. That trustee's moved on, changed firms, died. So at some point we get someone tries to make a change to a policy, and the forms say the XYZ trust signed by Joe Schmo. Well, the original trust documents and what the insurance company has that says that Steve Smith is a trustee. So then we need some additional information. So keeping up to date the trust or trustee information with the insurance company, any place where this trust is involved ahead of time, not necessarily at the point in time when you try to make changes, is going to be helpful. Here's a case in point. Thelma and Louise were co-owners of ABC Architects, and as part of their financial planning, their business planning, they purchased buyout life insurance policies owned by ABC Architects. So the ABC Architects was the owner and beneficiary of life insurance policies on Thelma and a policy on Louise. So Louise moves on. She decided that architecture wasn't her bag. So she moved on to making luggage, which I guess was her bag. Remember, it's the holiday season. You're feeling generous. So be generous with the eye rolls or laughs. Laughs, preferably. So now ABC Architects still owns a life insurance policy on Thelma and still owns a policy on Louise. Well, Thelma, being generous, says, we don't really need this policy anymore. There's no reason to have it. We purchased Louise's shares, she sold them back. So wanted to transfer the policy to Louise. After Louise left, Thelma changed the name, TJD Architects, but kept the same tax ID number. So you can probably see where this is going. At some point down the line, Thelma tries to change the ownership from the business to Louise. It was just a term policy. She thought it would be nice if Louise could have the policy. So when they fill out the forms, Thelma fills it out, TJD Architects. She signs it as the owner. Here's the same tax ID number. And so it causes confusion because at the insurance company, they have ABC Architects. So it causes some issues. Had we known about some name changes, and these are sorts of things that most people don't think about many times as they're making these changes. They come out when we try to do things like this. And it gets worked out, but it slows it down a little bit. This isn't anything that's not going to be overcome, but when we're proactive, changing names, changing information, then some of these things can work a little more smoothly. Now, that was ownership. Everybody's still alive. Beneficiaries are the ones who get the life insurance proceeds when the insured dies. You can change ownership when the owner's still alive. You can't change beneficiaries when the owner's dead. So keeping beneficiaries up to date and in advance is much more important as things change. When insurance companies ask for what do they need to do to update the beneficiaries, they're going to ask for the individual's name, social security number, address, and social security number, because sometimes, depending on if it's a life insurance policy, there may life insurance death benefit is tax-free, but if there's interest earned, that's taxable. If there's an annuity, then the beneficiary pays ordinary income tax on any gains in the annuity as a beneficiary. So there's tax documents required. So that's why we have the social security number. What if there's a divorce decree that requires certain amounts to go to people? Most of the time, this is something that's done in advance and sort of pre-qualified with the insurance company. Sometimes we've had scenarios where someone's not making very much, but the divorce decree says they need to hold X amount of life insurance. They may not otherwise qualify, may qualify for $750,000, and the divorce decree says they have to hold $1 million. So the divorce decree helps override maybe what, based on a multiple of income helps. And it's our opinion that no one should name minors as beneficiaries of life insurance policies. Minors cannot sign for legal contracts, can't open bank accounts. So naming a minor beneficiary directly always causes problems. And so here's an example. Here's Jim. Jim is retired. He's a grandpa. He had some term policies for income replacement as when he was working, and decided that he wanted to keep and convert, and we'll talk about conversion later, some life insurance as a way to pass some money to his grandkids. So he originally had the term and named his spouse as the beneficiary. Got to a point where they said, we don't need it for income replacement. Rosie doesn't need the life insurance anymore for income replacement. I'm going to use this $750,000 policy, keep paying the premiums as a way to pass some money on to our grandkids. And what Jim did is he called the insurance company directly. This did not go through our office. And so I'm sure, like many of you all, clients don't necessarily reach out to you to do things, but then when things go sideways, they look to you to help unwind them or fix them. So Jim actually called the insurance company and said, I want to change the beneficiary of my life insurance policy. Third and the third and the third to my 3 grandkids. And they let him do that because the insurance company, he was the owner. Remember, the owner has all rights of the policy. They're going to say, yes, sir, that's what you'd like to do. Here's the form and let's do it. And we'll do that for you. The insurance company person on the end of the line is not giving advice on how to set things up. They're not attorneys. They're not financial planners. It's a call center. So they're going to do what he asked. And so he named his grandkids the third and the third and third beneficiaries. Jim, unfortunately, passes away. And what happens is that the oldest grandchild, he was 22, got $250,000. Middle grandchild, she was 20, got $250,000. The youngest was 14. Guess what you can't do? You can't write a 14-year-old $250,000 check. So what actually happened was for about think it was close on 2 years, we were trying to work with the insurance company on ways to, because the insurance company wants to pay this money out. They want to, if there's a death benefit, they have a policy, they want to pay this out and kind of close the books on this. They had to sit and hold that $250,000. And while it's sitting there not being able to be paid out, it's generating interest. And so the insurance company and was working with us, they were reaching out even to the brother and sister to say, who has executorship or who has guardianship, who has any of these things that we can find a way to maybe create a trust or other things to be able to distribute this money. After about 2 years, it got figured out, but it didn't do what Grandpa wanted to do, which was to have it pretty much go to the grandkids seamlessly. So that's why we say don't name minors. You can name your estate. If you have young kids, you can set up trusts. You can have other type of trusts. Many things we can do, but we recommend not naming minor children as beneficiaries. If we're going to change the beneficiary to a trust, this is another one. Have a bank account in place. Go ahead and set it up now. Because what happens when someone dies, it's very hard. It's much harder to create a bank account when the insured is dead. If there's any forms needed, documents, what have you, than it is when everybody's alive, especially if it's a revocable trust. So setting up that bank account early on when the trust is a beneficiary gives the insurance company a place to write the check, to pay the check, and a place to cash the check. So you have a bank account in place. If you're making a change of beneficiary to a trust, the tax ID number of the trust, and again, up-to-date trustee information. Because when you do a beneficiary change, everybody has to sign some forms. If they're, say, 50% of the time, if you're changing the beneficiary to a trust, the insurance company is going to want to see some trust pages. Many times it's just the first and last page. A, is there a trust? B, who signed for the trust and where, when was the trust established? They don't need to see all the middle. So having all of that handy for changing the beneficiary of trust is important. It can be short, 1 pager. It can be long, 8 pages, mostly stuff that you don't need, but it can be long pages. So the point is we're here to help. Those are the sorts of things to keep you off the naughty list. If your client says, I need to change my beneficiary to a trust, now you know a little bit more of the things that insurance companies might ask them for. So if that's what happens, you can say, oh yeah, we knew that was going to happen, or even give them forewarning. Big one. Paying premiums on time. So one, what if the trust is a testamentary trust? No bank account can be created until the grantor passes. Correct. So a testamentary trust, that's something that can't be done ahead of time. If an adult brother and sister are beneficiaries on a life insurance policy and the brother, no children or heirs, passes away, is it important to update the beneficiary on the policy to just a sister? Or as the brother is deceased, would it pass to the sister or would it go through the owner's estate? Great question. Probably, even if I could find it back on some of these pages, you might not be able to see it. But there's usually language that says something as in per stirpes, per capita, that says, oh, here we go. If any beneficiary within the same class does not survive the insured, so in this case, primary beneficiaries, we name the brother and sister's beneficiaries, 2 primary beneficiaries, 50%. If any beneficiaries within the same class does not survive the insured, any share due to that beneficiary will be paid proportionally to the beneficiaries within the same class, unless otherwise specified. So to that specific example, if they're both primary beneficiaries and one of them is not alive, any other primary beneficiaries get the remainder. So in that case, the way this one's worded, without otherwise being specified, it would say, how many primary beneficiaries are alive? 2 or 1? Well, now it's just 1. They get 100%. So the cleanest, obviously, is to eventually update to just the sister, because that leaves no ambiguity. Because you never know if the brother has kids maybe that nobody knew about, and depending on how large of an estate this is, sometimes people show up claiming to be kids of the brother. Probably not for most people. So the cleanest would be to name the daughter as 100% beneficiary, but it's important to see that, you know, what would happen on that beneficiary form as far as if one of them was deceased. But that's the way it would probably normally happen for most, with no other, with the brother having no kids. Good questions. All right, number 3, pay premiums on time. Now, we kind of like everybody to have second chances, but this is one where we really kind of don't want, hopefully we don't have to have second chances. Because if you need a second chance, here's what happens. If you don't pay the premiums on time, insurance policy goes into what's called a grace period, which is a 30-day window where if I don't pay my premium by the due date, more letters, notices are generated saying your policy is in grace. It's technically still in effect, but you have another 30 days to get premiums paid in, and the policy, there's no changes to it, no nothing. We'll put it back in place as if it was good. Now, let's say looking at this, December 1st is the due date. If I pay the premium on December 15th in the grace period, my next premium is still due next year on December 1st. I don't get an extra, I don't get 12 months from when I paid it. It's saying basically just, we're gonna let it be as if you paid it on time. So one of the things we do is we send our APE emails, advanced premium emails, to let people know this is coming up. If clients are on monthly bank draft, we just let them know that that's coming, if they need to make changes to their bank or anything like that. But for anything where people are writing a check, this lets the client, know that these things are coming due. And it's helpful because maybe they're going to be on a cruise on April 4th. And this is going to be coming. So it gives people time to react to these things, pay early, contact us to let them know. Here's in general how it works. Client, for that particular client, their premium due date was 4/4. So about 1 month early, we send an email to the advisor and the client saying just what that email said. This is coming. This isn't the bill, but just be on the lookout for the bill. Most insurance companies send the premiums about 2 weeks to 10 business days before the premium is due. Sometimes it seems short to me, especially with sometimes how mail seems kind of slow, but I'm guessing if it was too far ahead, people put it away and forget about it. I'll get to that later. If it's too soon, well, they don't have much time. So policy has a grace period from 4/5 to 5/3, so that 30 days after, if the policy's not paid, and then 1 month after that premium due date, effectively one month and 1 day, the policy lapses. It's no longer in effect. During that grace period, client can just pay the premium and the policy's good. After 5/4, when the policy is technically lapsed, the insurance company has the ability to say, well, we'll just pretend it was a grace period, just pay it and we'll put it back. More than likely, they're going to consider this a reinstatement. So if you want to put the policy back in place after it's lapsed, we might be able to, but we're going to ask for an application with some additional information. So you're actually applying for the reinstatement. It's not a guaranteed. If I just make my premium on 4/15, policy's good. After 5/4, you're basically applying to put this policy back in place, and you might need to pay back premiums as well. Which leads me to number 4, really, pay the premiums on time. 3 and 4 are paying premiums on time, because if it goes into reinstatement, we're basically opening up the whole application process again. In Grace, you pay the premiums, policy's good. If it's reinstatement, we don't know what's going to happen. So here's a reinstatement process, one that worked out pretty well. Premium was received on November 7th. Check was returned by the bank for non-sufficient funds, and that's not great. A letter was sent, but they said, oops, you meant to do this, so we're going to extend the grace period to 12/27. Client said they sent a second check, but somehow it was never received at the insurance company. So the policy lapsed a couple of days after that 12/27, and you actually gave a couple of days there, so that was pretty nice. On 1/10, after we reached out to the client, said they never got the policy, they never got the premium. Have you paid this premium? Policy lapsed. We sent the lapse letter, reinstatement to the insurance company, application sent. The insurance company said, we can consider, because this is pretty recent, with no medical, with no exam, don't have to have the paramed exam again, but we want to see some recent medical records, doctor or something. I think it was primary care. So the client actually has to gather these details with a reinstatement application saying, since this policy was taken out, have you A, B, C, D, E, F, through probably Z, supply medical records. Luckily with this, their health hadn't changed. There were no changes to it. So the insurance company said, your reinstatement has been approved. We'll put the policy back in place. We need a check. And when they write a check on February 15th, it's going to basically go back to November. So even though they're writing a check for December, their next check is going to be due this coming November. So they're paying for those back premiums to keep the original, basically the original policy in place. Here's one that didn't work out so well. We'd had a client that we'd been working with who was on monthly bank draft, and we had a general history of every other month or so, the premiums being the policy going into grace for non-sufficient funds. Not once, not twice, 4 or 5 times a year. So something was just not working right here. So we had another example. Draft went in, return for non-sufficient funds. We sent the grace email. Client paid the premium for 1 month, but it's basically already back in grace period, because when they paid on 11/20, it basically just paid for 10/28 to 11/28. So they paid this last premium, but it didn't pay the current. It was just making up for lost time. So a grace email was sent again. The policy eventually lapsed. And this was because when these things happen, people feel like, I just paid that, I should be good, not realizing that when they go into grace, when they go into lapse, they're paying for back premiums, not the last 30 days. So policy lapsed in December. We tried for the reinstatement form. Policy was declined. The reinstatement was declined because the underwriting has declined reinstatement due to unadmitted prescription history. So in this case, the insurance company pulled their prescription history, and on that letter, on that application, the client did not disclose, I have a hard time saying some of these, but one of these is an amphetamine, fluoxetine, Suboxone. So multiple medications that weren't disclosed. Insurance companies don't like not disclosing things, especially multiple depression, anxiety type medications. So they said, thanks, but no thanks, we'll pass this time. All of that being said, if you pay your premiums on time, don't worry about it. You don't have to do these things. So number 5, what's the best way to not have premiums lapse? And if anybody can tell me who this person is, I need his name. I want to see if anybody can type into Claudia who his name is, what his name is. Let's see if anybody can do it. Because his famous line was, and eventually somebody's going to have Googled it, but eventually, what he said, I'm not only the Hair Club for Men president, but I'm also a client. These are so far no right answers. Some are pretty good. Ouch. These are good. I'm not going to read some of these because some of these are. All right. Now, good try, everybody. Good try. Cy Sperling. Cy Sperling, the Hair Club for president, but also a client. And why do I like this in this case? Well, I haven't gone to the Hair Club for Men. However, I use automatic bank draft on all of my policies. All of my personal policies use automatic bank draft. And you know why? I have a 15-year-old. I have a 13-year-old. I've got a soccer game tonight, and I'm not sure where or how I'm going to eat dinner. So life is busy. It's also, all of these things. So automatic bank draft means I never lapsed a policy. I've never had a grace period. Now, one of the things that we look at and talk about is it the cheapest option? No. Annual premium is going to have the smallest check that you're going to write. And then if we look at the bottom half of the screen, when you pay more frequently than annually, you pay more. Because effectively, the insurance company is going to take your premium and invest it to basically fund future liabilities. If they have $1,000 now, they get to invest it all year. If you give them $500 now and $500 in 6 months, well, that doesn't work out because they weren't able to earn interest on the $1,000. So there's an additional charge, plus some for just the fact of doing multiple transactions. So if we look at a semi-annual modal factor, you take the $1,000 and multiply it times 0.52. So a $1,000 annual premium would be $520 semi-annually, so $520 twice a year, $1,040. So you pay a little bit more over the course of the year. Quarterly, 2.27 modal factor. Pay $1,000 times 0.27, 230 times 4, 1,080, so 8% more. The best part, though, is that, I should say modal 0.088, not 0.008, 0.88, $1,000, $88 a month times 12 is 1,056. Only 5.6% more to go monthly. So why? Good question. Why would monthly cost less than quarterly? Because if we look at the top chart, quarterly causes more problems and causes more work. So to me personally, I'll pay more to do less. The insurance company in those first 2, 3, or 4 years, we're looking at lapse rates based on how people pay. Semi-annual, monthly, annually, all almost exactly the same for the first few years. In those first 2 or 3 years, 1 to 2 years, quarterly premiums are lapsing four times higher. Now, why does it cost more? It costs more because quarterly is still also usually a check. A lot of people like quarterly write checks. So it costs a little bit more to send the bills than it does to just do the monthly bank draft. But if I'm an insurance company, I like monthly bank draft because I don't have to look at it. Quarterly. Why does quarterly lapse? Quarterly lapses because I pay a quarter to put a policy in place. Maybe I get around to it. Policy was placed on January 1st. I get around to paying my premium on the 20th. Great. All of a sudden, a month and a half later, I get another premium for my next quarter. Okay, I feel like I just paid that and I'm late on that one. So quarterly, sometimes if you're late on a quarterly and you're paying sort of into that grace period, you start getting bills right about the time you're making premium payments, and it's just confusing. So monthly costs less because they built in that factor that it's a lot less work for them. So they want to try to steer people towards a monthly than the quarterly. And if we see on the lapse rates, quarterly, 100% of the time is higher than is at or higher than anything else, because it's just that quarterly premium. Most of the things we do in life aren't quarterly anymore. All right, number 6, stay off the naughty list. Watch out for collateral assignments. What's a collateral assignment? Collateral assignment is like a lien on your life insurance policy, on your client's life insurance policy. So when clients take out a loan, normally to a bank, the SBA loan, they want a collateral assignment. So it's like a lien on the life insurance policy that says, if client was to die, what happens is the insurance company goes to process that claim. Wait, slam on the brakes. I see a collateral assignment. So the first thing I have to do is go research this. And then what will happen is the insurance company will call whoever the collateral assignee is. Let's just call it Bank of America. And they'll say, Bank of America, I see a collateral assignment on Mark's policy for a loan. Does Mark owe you any money? Say, yes, Mark owed me $100,000. Great, we'll send you a check for $100,000. And then we're going to pay the beneficiary the rest. What's important about collateral assignments is that if I don't own a loan, if I don't have a loan anymore, if I've paid off the loan, I want to reach out to Bank of America and get an insurance company, us, whoever, to get the forms to say, I want to release the collateral assignment. Because let's say I've paid off my loan and I pass away. I want my wife, my kids, whoever, to get my life insurance right away. I don't want it delayed by the amount of time that that's going to take for collateral assignment person to call Bank of America to research. So even if it's zero, my wife still gets the $1 million. But if there's no collateral assignment, we want to get that released off the policy so nobody even has to look at it. So what does that look like? Here's what the collateral assignment is. Brad bought a business. Bought into a business, took out a loan to be able to buy into the business, $600,000 loan, or it was a $1 million policy because it was a $1 million loan originally when he got the funding. So have a life insurance policy with a collateral assignment to Bank of America. What's important is the collateral assignment doesn't ever name any figures. It's fluid. It just says, there's this lien against the policy, contact lender to find out what the amount due is. So we don't have to change the collateral assignment every year as the loan is paid down, which is wonderful. Brad eventually pays the loan down to $600,000 and passes away. Brad has wife Stephanie. So what happens with this $1 million policy? Insurance company, there's a collateral assignment on this. Brad's dead. Collateral assignment. Bank of America says he still owes us $600,000. They're going to write a check to the insurance company's going to write a check for $600,000 to the bank, and the remainder to Stephanie of $400,000. What's important here is that Stephanie on the policy is actually 100% beneficiary. She is 100% beneficiary, which basically says whatever the collateral assignment doesn't take, she gets 100% of. If there's no collateral, if there's no loan anymore, she gets 100%. If there's a big loan, it pays that off and she gets 100% of what's left. Sometimes we try to name the bank as a beneficiary. And that can go sideways because that loan is being paid down every year. So unless somebody wants to contact the insurance company monthly or yearly to change the beneficiary, which you don't want to do, it'll probably never be right. Stop clock is right twice a day. At any point in time, if I change the beneficiary to $492,000 to 67 cents, that's good today, but next month I have to change it again. So what sometimes we've seen people do or try to do is name the bank as $1 million beneficiary. Problem with that is without changing the beneficiary, here's what happens. You leave it to the bank gets $1 million. The bank says, well, he only owes us $600,000. I don't know what to do. This doesn't happen very often, but from my research, it can be considered that if the bank gets $1 million, they only need 600 to satisfy the loan. When they transfer the remaining $400,000 to Stephanie, which you would think they would do, then that might potentially be taxable to her because now we're mixing so many different parties. Sometimes the best laid plans go wrong. So if clients say, I need this for a loan, remember the idea of collateral assignments, not necessarily making multiple people beneficiaries, but collateral assignments that lay on top of that policy that fluctuate or decrease as the loan amount does. One of the questions to keep you and your clients off the naughty list, if they want to take money out of their permanent life insurance policies, so this can be whole life, VUL, universal life, are they going to pay it back? You can take money out of life insurance policies effectively two ways. Here we're talking about universal life policies. You can take a withdrawal. A withdrawal takes money out of the cash value. So withdrawal is like taking money out of your bank account from the ATM. Okay, so it actually is money coming out of the cash value. It's actually money coming out of the policy. And so when you do that, it reduces the death benefit of the life insurance policy by the amount of the withdrawal. So if I had a $900,000 policy, $300,000 of cash value, I take out $100,000. My cash value goes to 200 and my death benefit goes to 800. $100,000 is taken out of both accounts. And my death benefits actually went from 900 to 800 fixed. If I say, oh, eventually I want to get back to $900,000 of life insurance, I can't do that. I actually change the death benefit by taking a withdrawal, which is effectively a tiny partial surrender from the policy. But if I might want to pay it back, if I might want some flexibility there, then you can take a loan, where a withdrawal is like taking money from the ATM out of the checking account. So actually reduce my checking account. A loan is like putting that purchase on your credit card. My checking account, my actual cash value isn't impacted. My life insurance death benefit isn't effectively impacted. But I'm putting a loan, a credit card balance on here so that my net cash value is the same. My net cash value is lower by $100,000. And if I die, the insurance company pays off the loan with the death benefit. So my $900,000 policy, $300,000 cash value. If I take a $100,000 loan, my net cash value is 200, my net death benefit is 800. So initially about the same thing. But my actual life insurance policy values aren't impacted, just like my credit card against my checking account. I can pay it back. I can pay back the loan. And the death benefit is back to 900,000, my cash value is back to 300,000. But if I die, if I cash the policy in, then the loan is paid off. So I end up with the same net at death, same net at surrender, but I can pay it back. Why, when are we really going to worry about this? Well, Doug and Gloria had some life insurance policies. They were found a smaller house. They were downsizing. The kids have left home. And what happened was they found a great house. They wanted cash quickly. And they had quite a bit of money in their life insurance policies, almost 1.3 between the two of them. These were big cash value life insurance policies. And what Doug contacted us and said, as compared to going out and getting a commercial home loan all through the paperwork, can I access some of my cash value and then effectively pay it back so that I can buy the new house without delay? And then when my old larger house sells, I'll pay back the loans, which they took $850,000 out of Doug's policy, $250,000 out of Gloria's on the loan, and 3 to 4 months later, they paid it back. Had they taken withdrawals, they couldn't have paid that back. That cash value would have been irreparably reduced. The death benefit would have been reduced because of the loan, and wanting to keep the permanent life insurance, they were able to take a loan against the cash value and then pay it back shortly. So this is probably not going to happen for many of your clients, but again, important to know things to ask. How do we keep life insurance going even with a healthy client? Conversion. What is a term conversion? This is a conversion. If client has a term policy, it's a contractual right built into the policy that lets them trade their term coverage for permanent coverage without any health underwriting questions asked at all. And we keep, like our advanced premium emails, we keep up to date with this on your clients with our notes, notification of term expiration, which also lets clients know about conversion expiration. And sometimes we think about people hitting age 65 or 70 and wanting to convert their policies, but other times it makes sense for people who aren't just ready to trade their term for income replacement for permanent and legacy planning. Client was 37, had a $250,000 10-year term policy issued at standard rates in 2006. That 10-year term policy was expiring, but needs life insurance for another 15 to 20 years. His health had changed. So now he's a Table D, Table 4. So $150,000 new policy, 15-year term, $1,300 a year, $150 for 20 years, $1,488. If we were to apply for a new policy and get the Table D rates, which is effectively 100% more than what standard rates were. But because this policy has a conversion through the term period, we could convert the term policy at standard rates. Conversion is cool because there's no health underwriting, so you keep your same rate class. So $150,000 conversion would be $959.40 a year, 27% less than the conversion rates, guaranteed for 15 years, but projected to last 23, cost less per year. So conversion is not just, I'm getting to the end of my term policy and I want to leave a legacy to my kids or my grandkids. It can help for clients who still need coverage. John and Daniel both had $1 million 20-year terms. They owned an office cleaning service. They had these policies for buy-sell. The term was expiring. John, still great health. Probably could have gone out and applied for other policies. Daniel, though, had some issues with alcohol abuse and counseling. So both of their term policies were issued at preferred rates. If we were to look at new policies for Daniel, Table F or Table 6 is 150% more than a standard rate. So a term rate would have been 150% more, 250% of a normal term policy. So what they decided to do was, so that they matched, convert both of the policies until age 95. Ended up that Daniel's premium wasn't a whole lot more than a new 20-year term policy at those higher Table F, Table 6 rates. Number 9, know who to contact. And this is just if clients ever have to go on claim. know who to contact. And it can be the agent, it can be us, it can be you, but somebody who's going to get some of the wheels turning. In 1971, we meet Tony. Tony was born. And in 1971, voting age was lowered to 18, and the Dow Jones closed at 890. Pretty neat 1971 facts. Along the way, Tony met Brandy. They got married. They had a son, and about that time, and he was self-employed, like many of you, and about that time, he'd started working with his financial advisor and gotten some life insurance policies. And we actually did a term layer for Tony, so we had more coverage, layered short, medium, and long-term term policies, so a lot of coverage while their son was small. And as time goes on, the coverage decreased as he got closer to retirement age. Unfortunately, in 2015, he died in a boating accident. So what's important here? Knowing who to contact. And because we'd had those policies, Tony's advisor, Michael, called our office and reached out to let us know, hey, are those life insurance policies still in force? And the answer was yes. So the policies that were going to go to Brandy were in force. So that was the first thing. So a sigh of relief at that point. We emailed policy info to the financial advisor along with claim forms, how to contact the insurance company, what they were going to ask for as far as processing claim, because if you all have ever had this with a client, you're probably more concerned about this part than they are at that moment. 2 months, 3 months, they're going to want to know where's the money to make life happen. But probably in that moment, you're thinking about that and they're thinking about other things. So very helpful to have the life insurance process being marshaled along by us and you. Got in talked with Brandy on January 26th. She'd been in contact with the insurance company, mailed all of the needed claim forms, death certificates. About a week and a half later, the death benefit was paid. So Brandy had her money. It wasn't, again, some of the slowdowns are that this is not necessarily what she's dealing with right away with a young child and a death of a spouse. But we're helping monitor these things to get to that end result that we need. We got a note from the advisor. Brandy received her life insurance checks. Thanks for your and your team's help. Terribly unfortunate situation, but glad we could partner together to make sure their family is covered during this tough time and for many, many years to come. It's why we do what we do. It's why you do what you do. And so many times just knowing who to contact to get those wheels started or those wheels turning is important. Number 10 is for everybody to have a happy new year. Thank you to everybody for being around for our webinars all year. Thank you for helping us help you and your clients all year. We have a great group of people here in our office that I have a lot of fun working with every day, and a lot of advisors who I have a lot of fun working with daily too. So thank you all for being great. Thank you for this year. Hope to have a great year next year as well. But next year, what happens? Some things turn 25. You know what? Google was founded. Believe that? 25 years ago, Google was founded. Only 25 years ago were we getting jiggy with it with Will Smith. Believe it or not, I feel like I've been getting jiggy with it for a long time. Actually, I don't know that I've ever gotten jiggy at all. Goodbye to Seinfeld, 25 years ago. It's been 25 years since we saw the last Seinfeld. And I don't believe this one. The first, as far from my research, the first Harry Potter book next year was published in the United States. That one's hard to believe. And why am I thinking all these things? Oh, LLIS was founded 25 years ago next year. So, we're in pretty good company with Harry Potter and Seinfeld, and so, I'll take it. But thank you again, and next year we'll be celebrating 25 years. One of the ways you can help celebrate with us is coming to our Insurance Academy, February 1st through 3rd next year, which is so close. Next year is not very far away. So come listen, more insurance, 2 days of insurance, some fun, some good food, and you know what? It's Clearwater Beach in February, so may not be, I can never promise warm, but I can pretty much promise it'll be warmer than where most of you all are coming from. So come celebrate with us. And for those of you all who aren't very familiar with us yet, what are things that makes LLIS different? We do our free monthly webinars. We don't have our 2023 schedule up yet, but it will be coming soon. We work with Feeling Advisors to help save time, save clients money by doing a lot of pre-underwriting to avoid surprises. I didn't talk really about the underwriting process in this exam because this was a lot of things about people with policies already in place. But through the course of the year in our academy, we're going to talk about the changes in the application processes over the years. And we have specialists in life insurance, disability insurance, long-term care, annuities, hybrid policies that help with all of those nuances because things are always changing. And we are proud sponsors of a number of different fee-only financial planning groups and have been for many, many years. And it's just a wonderful group of people to work with. So again, thank you for all of you for allowing us to be part of it. We have Alice, our client and advisor portal that we're sort of always working on. And I don't think I see any more questions. So we have a minute or two. I'm happy to answer any questions you have. It can be about this topic, about anything else. I know a fair amount about Harry Potter trivia. Going off Harry Potter again. Actually, a good amount of Seinfeld trivia probably, but I think some people out there would probably stump me. No? Well, thank you again to everybody for tuning in. Seeing no other questions. Wait, somebody said wait. One of the questions was why such high lapse rates in year 15? That's a good question. What we'll see is the really big lapse rates, which are not surprising at the end of the level term periods. And so we're going to expect that we have big jumps at the end of 10, 15, 20 years. I don't particularly have a good reason why the 15 is higher than other numbers. Most of it's going to be related to the term policies dropping off, but then why, if it's built into other companies, so a good question is, I don't know exactly that one. The spikes correlate to the normal end of regular term premiums. Ooh, and somebody said they liked my jokes. All right, that's the best present I think I've gotten. So thank you, everybody. Thank you for 2022, and we'll talk again next year. Thanks. Bye.